Hey taxpayers, this is my first video since tax season wrapped up about a week ago, and even though I gained about 3 pounds and my blood pressure spiked because of all the stress, I still survived. But something really interesting happened this tax season, especially around the notion of just the amount of misinformation when it comes to business structures. You see, I personally deal a lot with sole proprietors, and sole proprietors are individuals who earn side income through, I guess, self-employment or side gigs, side hustles, whatever you want to call them. But generally, as sole proprietors make more and more, the question becomes, how do I formalize this business more, well, formally? And generally, the two options that people talk about are LLCs and S Corps. So it begs the question, which is better, LLCs or S Corps? And this is a question I actually get quite often during tax season. Now, if you understand the issue with this question, then congratulations, you're already one step ahead of the curve. But if you don't see the problem with the question, then let's take a quick review. You see, LLCs and S Corps are not mutually exclusive. They're not either ors. It's not like a coin flip where it's heads or tails. Again, LLCs can actually elect to be S Corps, just like S Corps very well could be LLCs. So this question of what's better, LLCs or S Corps, is pretty flawed because it's like asking the same question of, well, what would you like to have? Would you like to have a bowl of fruit or a plate of apples and bananas? I think we can see that question is pretty flawed. So again, that kind of goes back to the LLC versus S Corp. That question in itself is inherently flawed. So in order to understand exactly what LLCs and S Corps are and see which of those options, again, could better fit you, we need to understand what LLCs are and what S Corps are and why, again, you very well could have both. Now, if we go back like a minute ago, I did say that I deal a lot with sole proprietors. And given that the name sole proprietorship is, well, we can dissect it. Sole meaning individual, one person, proprietor meaning business owner. So again, a sole proprietorship is a business that's owned by one person. Very self-explanatory. And sole proprietors are probably more abundant now than ever. I have no data to back that up, other than, again, inflation's been crazy. People have been doing other jobs on the side in order to make ends meet. And like I said, a lot of us seem to be dealing more with sole proprietors. So there we go. But what makes sole proprietors interesting is, well, as a proprietor, you probably have what are known as personal assets. This is the value of things like your house or your car, your jewelry, maybe your super rare Pokemon collection. Again, all of these have some sort of value to you personally since they're not relative to the business. But by the same token, you're also going to have what are known as business assets. These are the values of assets that are related to your business. So these could be things like inventory and equipment. Now, the inherent issue with a sole proprietor is even though maybe on paper there's a difference between your personal assets and your business assets, in the eyes of the law, there really is no distinction between the two. So in the event that you were to be sued, again, even in the ordinary course of business, they may be able to come not only after your business asset, but your personal assets to cover any type of outstanding debt or issues, judgments or whatever that's going on. And that could be very detrimental. And like I mentioned a little bit ago, when I say I deal with a lot of sole proprietors, once you start kind of, making more and more, your business is being more formal, it's time to look outside of being a sole proprietor because again, you probably want some sort of legal protection, which is where an LLC comes into play. Now, LLCs are great because, well, first off, they're called LLCs because they are limited by liability companies. And a limited liability company, or again, LLC, creates this magical barrier between your personal assets and your business assets that help kind of defer and knock away any type of lawsuits and protect your personal assets. So at a high level, LLCs sound great. That means I can keep everything in my personal life intact. Well, sign me up. Well, sadly, not really. You see, that's a big misconception with LLCs. It's because even though that, yes, LLCs generally create this magical barrier that separates your personal assets and keeps it safe from all, lawsuits that relate to your business, that doesn't hold true all the time. Because again, there are situations that are called piercing the corporate veil. And piercing the corporate veil basically just means that any types of lawsuits can just pierce that LLC barrier. So one thing you will really need to do if you are looking to get an LLC is to make sure you keep these two separate, especially when it comes to bank accounts. Because again, in the eyes of the law, if you have your personal checking accounts all mixed in with your business accounts and all that, well, again, if in the event of the specific lawsuits or whatever, if they can't determine your financials, again, and separating between personal and business, they may see it as all business and, well, that could be a very big problem. So again, we want to make sure that if you have an LLC that we do keep a firm distinction between what's personal and what's business, especially when it comes to bank accounts and cash transactions, because that's probably what's going to be the most numerous. And that's going to be one way to, again, make sure that we don't pierce that corporate veil and keep that LLC barrier intact. Now, a huge misconception when it comes to LLCs is, again, like I just mentioned, that your personal assets are going to be, safe in any type of lawsuit, which again is not the case, especially when it comes to negligence, because negligence can just completely disobey this LLC. It'll pierce the corporate veil and your personal assets are going to be at risk. But the way that they measure negligence can be a little bit questionable, I guess, because again, I'm not an attorney. So for example, I have clients that own landscape businesses. Now, they have LLCs because that's a smart thing to do, because the job that they do inherently has some sort of risk of being sued. They could run over a special plant or damage a car or scratch up a fence or whatever. But let's say hypothetically my client goes out, is mowing the yard just like normal, but hits a small rock and that rock flies out and hits the family dog, and now the family has vet bills, or maybe it scratched up and broke a window out in the family's new Mercedes or whatever, and my client gets sued. Now, will the LLC protect them? On the surface, I would say so, because again, the just running over a rock is an inherent risk of the job, which again, the LLC could help. But again, there could be the other side of the story, and they say that, no, my client that was riding the the mower was negligent because they should have seen the rock there in the grass, but maybe the grass was like, 6 inches tall and the rock was down here. No one could have seen it. So again, that's where we have to go back and forth. And again, that's for the lawyers at that point. But let's take it another step further. I'm going to pick on this client even more. Let's say it's a Monday and the rest of the week's forecast is rain. So they need to get out and do these yards today, because if they wait, well, all the rain's going to make things muddy and mushy. Everything's going to grow because, again, of all the rain. So they need to get out today in order to get the jobs done. So again, the crews are out, they're doing their jobs. My client's about to leave with his truck and realizes that the tow hitch on his truck is broken, so he cannot haul the trailer. So in an act of desperation, he hooks the trailer to the truck using, let's say, rubber bands and duct tape. Now, what happens is he's driving down the highway and the trailer eventually breaks and the trailer goes off and hits a family's sedan and whatnot, causing mass injuries and possibly worse. Now, would the LLC protect him in that case? Absolutely not, because anyone with half a brain cell could see that, okay, if you try to attach a trailer to a truck using rubber bands or duct tape or whatever example I used, that is pure negligence. So at that point, I can't see any lawyer saying, oh yeah, the LLC is going to protect that. Now, if you are a lawyer that will protect it, let me know. I'm just be really curious to know. But again, at that point, that is just pure negligence. So no, the LLC is not going to protect you. So yeah, LLCs are great. And again, I push for LLCs, especially if you are a sole proprietor who's earning, more and more income, and you are in a line of business that inherently has risks of, again, some sort of lawsuits. But again, just note that this barrier, again, the LLC veil that is created with an LLC is not all protective. There are going to be situations that very well could go right past it and get your personal assets if needed. So again, yes, an LLC is great, but it's not going to be the surefire way to protect your personal assets all the time. So again, if someone tells you to get an LLC because your personal assets are protected all the time, sorry, but they are completely lying to you. Now, taking this a step further, LLCs actually come in a couple of different forms. You see, if you create an LLC by yourself, it's called a single member LLC. But if you create an LLC with other people, it's going to come as a surprise to you. It's called a multi-member LLCs. And multi-member LLCs are actually just taxed like a partnership, which again, I'm not going to get into this video, but I want to talk about single member LLCs because generally that's the biggest majority of LLCs that we see is, again, someone is a sole proprietor, they want some sort of legal protection, in their business, so they form an LLC by themselves, so they are a single member LLC. Now, here's the interesting thing about single member LLCs. The IRS sees them as disregarded entities, which again is a whole nother misconception when it comes to LLCs. And see, single member LLCs, AKA disregarded entities, have their own misconceptions because you've probably been told that, again, single member LLCs don't pay taxes, which is true in the sense that the LLC doesn't pay taxes, but you do. And also taking another step further, people get LLCs because they think it's gonna open up all these different types of tax deductions available to you, even if you were just a sole proprietor, which again is also just completely false. So to put this into perspective, let's say I got two tax returns here. One is from a sole proprietor, the other is from an LLC. Now let's assume that everything about these two tax returns are the exact same. So either they're both single, they're both married, they have W-2 incomes between the two, whatever. Literally the only difference between this one and that one is that this is a sole proprietor and this one is a single member LLC. So here's the question. What's the difference in tax between the two? Well, in theory, the answer is nothing because again, even with a single member LLC, that is a disregarded entity. So the IRS doesn't even care that it's a business. There's not going to require additional forms or anything else. So from a financial standpoint, their tax returns are going to look the exact same in theory. But in practice, technically the single member LLC may have a couple extra deductions. So again, usually you have to pay like an annual fee to your state for your LLC filing. If it's the first year that you filed an LLC, usually if you hired an accountant or an attorney to do it for you, there's costs of that, which again, I would say it shows up on your Schedule C. But again, when it comes to the whole overall return, there's no difference between sole proprietors and single member LLCs. Again, in theory, but again, little extra costs to run the LLC will show up on there. So yeah, that's sometimes bad news for people who think they opened up an LLC. That's going to open up all these new tax deductions and credits and so forth. And the reality is, if you're a single member LLC, no, it really doesn't. Even if you're a multi-member LLC and you have a partnership, it doesn't open up really anything additional in terms of tax deductions. Now, it usually costs a lot more to file a partnership return. So yeah, you've got more, money to pay your tax person to do that. So that's more deductible. But again, you're not getting all this extra benefits of having an LLC. So it really just comes down to, do you really need that LLC protection barrier? And again, if your business is in the line of business has some sort of inherent risk, then yeah, go for it. It's good to have it than not. But don't think that just because you have an LLC that your personal assets are always protected or you're going to get like all these tax benefits, because the reality is sadly you're not. All right, so I think that's enough talking about the LLC. So let's switch to the S Corp. Now again, S Corps are not mutually exclusive to LLCs because LLCs can elect to be an S Corp. But what makes S Corps so appealing is that they can potentially reduce, if not eliminate, your self-employment tax, because LLCs are subject to self-employment tax. Not just income tax, but self-employment tax is an additional on top of income tax. So you've got two different types of taxes when you are subject to LLC earnings. And currently the self-employment tax rate is 15.3% of 92.35% of your self-employed earnings. Say that 5 times fast. So again, 15.3% of 92.35% is what is subject to self-employment tax. And again, that's outside of income tax. So everything else, again, still subject to income tax. So you could be very well surprised if you don't have proper tax planning when it comes to earning a substantial amount from self-employment. So again, S Corps are usually looked at as favorable because again, it can reduce that self-employment tax hit. And which again, if it's 15.3% of 92.35% of your self-employment earnings, then well, that could be very beneficial in order to reduce that. But can S Corps completely eliminate them? Well, it depends, because again, when it comes to having an S Corp, one of the things you have to be able to do is pay yourself a reasonable salary. Now, here's the thing, reasonable salaries are still subject to self-employment taxes. So let's say hypothetically you are an LLC, you earn $100,000 through, again, self-employment. And again, you do not elect to be an S Corp. That $100,000 is still subject to both income and self-employment taxes. So bam, bam, double whammy. But let's say same scenario, same $100,000, but this time it goes through our S Corp. Now the S Corp, again, now we have to have some sort of reasonable salary. Now, what is the reasonable salary? Well, it depends. What job are we talking about? What geographic location are we talking about? What are your tasks? What are your duties? All of these come into play in order to determine what is the reasonable salary that you should take. And it should go without saying, if you're paying yourself a reasonable salary or wage, that means you're gonna have to pay yourself a W-2, which again, by doing that, you have to have some sort of formal payroll system, which is something I'll kind of get into a little bit. So again, even though you still earn $100,000 through your side business, the question becomes, as an S Corp, how much of it is going to be paid to you through a W-2? Well, if you say, $5,000, because again, maybe that's reasonable because that way only $5,000 is subject to self-employment tax and the other $95,000 I'll just take as a distribution, which distributions are not subject to self-employment taxes. Well, heck, there we go. That looks really great on paper when it comes to tax. But the question becomes, is that $5,000 reasonable? Let's say you worked 80 hours a week every single week for the year, and you were doing some sort of like specialized skill. I'm sorry, but I don't really think that may pass. So we do need to make sure that we have a reasonable salary that, again, relates to whatever job you're doing, again, your geographical location, because people earning wages here in Indiana is going to be different than the same job being done in California, which again, that's just life. And again, we need to make sure we have a reasonable salary because again, that's going to be still subject to self-employment taxes, whereas anything that is going to be taken as a distribution up and over our, again, reasonable salary is going to be free from self-employment taxes. So generally, whenever you get into this kind of teeter-totter, we want to make sure that our reasonable salary is reasonable and not well overstated because again, we'll be paying more and more self-employment taxes than necessary, but we need to have some sort of reasonableness because again, hence the name reasonable salary in order to, again, not draw any unwanted attention. And usually that's the biggest reason why people love S Corp so much is because again, no one wants to pay more taxes than they need to. So if there's a way to reduce that self-employment tax hit, heck yeah, let's take it. And usually that's the great appealing thing about S Corps is because again, you would think that generally you can get 100% of your business income without getting hit by self-employment taxes. But there's the gut punch. You got to pay yourself a reasonable salary, which reasonable salaries are still subject to self-employment tax. So again, that's one thing you kind of have to work out is, okay, what is the reasonable balance between what should I pay myself as a reasonable salary, which again, generally you want to have some sort of research behind it. You can go to, salary surveys, was it Glassdoor, Robert Half, for your location, the jobs you do. And usually I can kind of give you a nice little, ballpark of what to do. And then again, any type of distributions you take up and beyond your reasonable salary is not going to be subject to self-employment tax, which again, there we go. Now, like I said about a minute ago, when it comes to getting yourself a reasonable salary, you have to pay yourself a W-2, which means you're probably going to have some sort of payroll system in place in order to, pay yourself every week or 2 weeks or whatever your payroll process is going to be. And that's going to be an additional cost. So going back to a scenario where you have an LLC and you have an S Corp, everything else is the exact same. The only difference is the one's an LLC and the other one's an LLC electing to be taxed as an S Corp. So from a dollar standpoint, they're both the exact same, but inherently speaking, the S Corp is going to have additional expenses because the LLC alone isn't going to have to be paying a payroll processor because again, the money just gets deposited into the business account and you just take what you want as the owner. But as an S Corp, you have to have, again, a formal paycheck being printed, which again is usually going to have some sort of an administrative cost behind it because usually payroll processor, softwares, vendors, whatever, not only make sure that you get paid every week or whatever, but they also do the tax filings, again, the wage transcripts and all that for you, which is not going to be free. So just know that if you are going to move from an LLC to an LLC electing to be an S Corp, there is going to be additional administrative charges. The first being the cost of implementing a payroll. Generally, they can be pretty cheap. They can be running from as simple as like $200 a month. If you want to have a bookkeeper on staff, that's going to pump you up even more. But again, that's more formalized. So again, you're probably, as an S Corp, you're going to have balance sheets and income statements, whereas in just an LLC, maybe not as much depending on the level of involvement or the level of financials. But also from a tax return perspective, the cost of producing a tax return for an S Corp is significantly higher than just doing, Schedule Cs if you were just an LLC. So again, not only do S Corps come with the added cost of having, payroll implemented, but the additional cost of tax returns and tax preparation, tax consulting, and all that fun stuff is going to be higher with S Corps just because it's going to take more time and it's just more exposure to risk. Now, as a general rule, whenever I'm talking with sole proprietors and LLCs, I don't even bring up the concept of an S Corp until they start netting, not grossing, but netting about $40,000 in self-employment income. Because at that point, the conversation steers to, if you're going to continue to make more, year over year, it's probably going to make sense to elect to be an S Corp because at that point, depending on what your reasonable salary is going to be, depending on what your job and, all that other fun stuff, the drop in self-employment taxes is going to be greater than the increase in administrative costs. Because again, the rise in administrative costs are going to be things like implementing a payroll system. Again, consulting fees, tax preparation fees are going to increase quite a bit, going from a standard Schedule C to an S Corp filing, because again, it just takes more time, it's more risk, and again, fees usually increase for that. But again, it's usually when you start netting 40,000 when the discussions are to be had, but usually when you start netting 50 to 60,000 is when the conversations are going to be more aggressive and pushing you to get an S Corp, because at that point, financially it does make sense, because again, depending on the reasonable salary, that drop in self-employment income is going to be greater than, again, those costs. And at that point, moving to an LLC generally is a no-brainer. So at the end of the day, what is better, an LLC or an S Corp? Well, hopefully by now you've realized that they can work together in your benefit, because LLCs can produce, again, that legal priority protection between your personal assets and your business assets, but just know it doesn't always work, especially in cases of negligence. And an S Corp comes into play, especially when you're making $40,000, $50,000, $60,000 plus net, because at that point, from, again, self-employment taxes, the drop on that relief from that tax burden is going to be greater than the additional, administrative costs. And at that point, it makes more sense. So kind of as a highlight this, if you are a small business, you're only, netting about $20,000 a year, and you want to open up an S Corp, chances are it's not going to be in your favor. Even though you're probably thinking, oh, I'm going to save money on self-employment taxes. Generally speaking, your administrative costs are going to be higher than the drop in, again, self-employment taxes you're going to get. At that point, it really doesn't make a lot of sense. So that's why people like me and my colleagues and a lot of other tax consultants don't even talk about S Corps until you start netting, again, $50,000 plus. So again, if you ever come across someone or some agency that's going to, trying to push you to get an S Corp without even knowing your bottom line, be wary of that, because again, it may not be in your best favor. So yeah, that was a whole long-winded way of saying that LLCs and S Corps are not mutually exclusive. You can choose which one that's going to be best for you, depending on your facts and circumstances. So hope that helps.